The Hedgeless Horseman here. It's July the 3rd, 2024. This video will be about, copium or common sensium, because the biggest favor one can do is not really just providing copium, because that's a band-aid. Yes, sure, I put out a video, someone, take some advice, even though this is not investing advice quote. I was like, okay, I get it. I'm not going to sell cheap. And that might last for a day or two. Then you get, confused, anxious again, and all of a sudden, and especially, let's say the market goes down, your portfolio goes down 2 days, then you're like, oh, now I need more copium. Because the previous dose have worn off. Like I said before, the biggest favor you can do is not, or the saying, give a man a fish, he'll eat for a day. Teach a man how to fish, and he'll, eat for the rest of his life. That's the idea. That's why my videos tend to be very, very lengthy. Because, I want to really cover stuff that's like, because once you get the underlying theme I'm trying to, purvey, then you hopefully won't need copium, because again, this is like you're just putting on a band-aid. You're just treating the symptoms. If someone needs copium like every 2 or 3 days, and first of all, it's not like I don't get rattled, or that I don't feel like selling, or I don't get affected at all by volatility or whatever. No, I just make sure that most of the time I don't let my feelings dictate. I don't let the Twitter sentiment dictate. You stick to the facts, you stick to a common sense strategy, you stick to buy low, sell high, you stick to value investing at all times, in any weather. If it's a big up day in the market, if it's a big down day in the market, if it's a 4-year bear market, if it's a 4-year bull market, in all different weathers, you stick to your guns. You stick to one strategy, because otherwise it doesn't make sense. You can't have one strategy really for buying that doesn't matches with your, let's say, sell conditions. Because if I buy because of technical analysis or whatever, it's like, but I sell based on value, that really makes no sense. Because in that case, well, if I buy when there's an obvious breakout or an uptrend or whatever, well, you never invested based on value anyway. Maybe your buy condition, from your TA says buy, but if you use value investing approach, own the cheapest stocks you can find as a buy condition, and if they're not the cheapest ones, you use that as a sell condition. The buy and sell might be at the same point in time. A breakout happens to the upside because price has gone up. If value hasn't gone up as well, it's like, okay, now it's a worse buy for a value investor, but for a technical analyst or whatever, or a trader, that's a buy condition. They don't match at all, typically. Because how often do you see a trader buy a breakdown? But you see a value investor buy a breakdown. Oh, something got cheaper, I'm going to buy more. It goes down even more, I'm going to average down. No trader would be doing that. And people would have stop losses and whatever. So they're getting out when the value investor is getting in. And they're getting in when the value investor is getting out. So you have to stick to one type of strategy that actually, again, where the buy and sells have a relation to each other. So it's like my wish is that, why I hammer home the same points kinda, it's like the goal is that you will need less and less copium, because you can provide copium to yourself from just reminding yourself of the basics, or your investing strategy. That is like, there's no value investing, I should follow that in these market conditions, but not the other ones, whatever. That's not really a good strategy. That's why I don't listen to any kind of macro talk really. Yes, I have some ideas where I think gold and silver is going, because hey, that's why we're in this space to begin with. But you don't even need it. You can find big winners even in a depressed market or in a bear market. We've seen it. It's just that this sector is also predictable because it's a broken clock. It always goes down, it always goes up after it's gone down, it always goes down after it's gone up. So we have that in the back pocket. We know it's a cyclical sector. You can make money on just the fact that it's a cyclical sector, but if you do that, you still need to buy low and sell high. Because you're, again, it's like there's a time to be in and out, especially with beta trading sardines. First of all, thanks to the sponsors. Let's dig in a bit. First look at markets today. Metals and commodities overall seem to be doing quite well. I mean, silver's above $30 again. But let's look at silver. It's like this is what silver has done over the last 1.5 months. Yeah, it's down a bit, whatever, from the top, but it's up since, I mean, it's highest it's been since basically 2013. Here, sentiment was red hot already here. You see the moaning, you see the whining on Twitter. I mean, we've had bear and bull markets declared a number of times just in the last 1.5 months. Here everybody got bullish, here everybody got bearish. Now they're bullish again, and here they're bearish again. And now I guess, they're bullish again. But it's like, what really changed? Did your silver units really change that much in value? Because silver is at 31 or 29 or 30? Nope. But it affects everyone basically. It's like, you gotta remember an important thing. It's like you see every single day, you're getting flooded by opinions. Absolutely flooded by opinions. 98% of those opinions is gonna come from people who don't really beat the market. Every opinion makes sense from one perspective or some perspective. It comes from somewhere. Still, it's like I don't know. It's like if you just assume there's like nobody knows what they're talking about, that's actually a good start. Because you see, there's a lot of strong opinions held, but it's like, especially if they involve whining. That comes from frustration, and that comes from frustration with results or anxiety, not really knowing what you're doing and all that. So as soon as you see a post that involves a lot of whining and comments, and that's a lot of them, especially if it's we had a correction or whatever, that's not coming typically from people who know what they're doing and who have a good investing strategy. So you can basically throw all of those comments out the window. Because if you get advice or you see opinions from frustrated people because they're frustrated because they're again, most of the time it's because they don't really know what they're doing, so they get anxious and then they whine about the market or whatever. Why would you take advice or listen to opinions in that case? I try to watch and learn from the Rick Rules and stuff. Their opinions matter to me because they have shown that they know how to beat this sector. But a random guy on Twitter, for example, that's belly aching and saying, you can't make any money in this sector. Why on earth would you? It's like he obviously can't make money. Rick Rule can make money. Then Landins can make money. Why are we listening? I mean, why are we listening to those people? It makes no sense. Why would you take advice from people? It's like you're pretty sure, just based on statistics, that they don't really know how this sector works or have a strategy. And that doesn't mean that's like, if you beat this sector over the long term, that means your portfolio's got to be up at all times. No, absolutely not. This sector, again, it's like 80% of the time it's kind of crap. 20% of the time it, revalues. I mean, look at this period. One could say from here to here it's consolidation. Boom, an upshoot. But here it topped, went down, so it consolidated I mean, in a sense, one could say it's like this period was consolidation. Then it shot up. And then started consolidating. So in a sense, it's like, most of the time does really nothing in the grand scheme of things. Then it shoots up, but that can happen over whatever. It's like 2 weeks or something. Then you have the into a higher orbit, what have you. Then it consolidates again, and then it shoots up. But this, for example, this one, 2 days, and that move was already over. I mean, the move started down here. So if you were along for the bottom, that's a bigger move, obviously. But it still wasn't higher than here. So it's like the net changes of getting into higher orbit, that can play out over days or weeks in this sector. And now it's actually been consolidating again. So it's like, do you think people were cheering here? No, because it's not higher than here yet. Were they cheering here because it's done this? No. Here they cheer because now it's higher and it's gone vertical. Now it feels really good. That's just in time for a new consolidation. So it's like most of the time, this sector is not that exciting, even though if you look at from the grand scheme of things, well, if you look from this move up here, that's a really good move, right? But it doesn't feel like a really good move because when it's up here, it's still lower than where most people might have bought in, here or here or whatever. So it's like this sector is riddled with frustration. The only time people are not really frustrated is pretty much during the short stretches where it goes vertical at the end of a move, let's say. Because, this move here is still not higher than here. But here I think, people got bullish again because it was going vertical. And people were obviously extrapolating that move. Because if it has gone like this, if that continues, we're going to be at $50, by the end of next month. My point is that most of the time, it is not exciting. And everybody pretty much has a short-term time frame. So here everybody's excited, and now everybody's kind of bearish again. That's just how it is. If you understand that, then it's like, okay, good. There's nothing to be alarmed about that people are bearish or bullish, whatever. Again, people were very bullish here, bearish here, bullish here, bearish here, bullish here. You can see it on Twitter, the belly aching. Here we're talking about upside targets, here we're talking about downside targets, yada yada yada. And everybody has an opinion, and especially, let's say if you sell a service or whatever, you have to have an opinion, kinda. Especially if it's a trading service. Because think of that crowd. If my target audience, let's say, was short-term traders, 95% of all investors or speculators would be my target audience. How many are like, hey, I like to, figure out some stocks where it's like, let's say I buy here and then forget about it for 2 years, not needing any more guidance for 2 years, and let's see what happens. If the case plays out, I'm going to be up a lot. That's quite hard to sell a service. First of all, the target audience is so small because nobody has that kind of time frame. And you would be like, let's say you buy a newsletter once and then come back in 2 years. You don't need to buy any other newsletters in the meantime because the cases are 2 year long. So that's when, you can find, in 2 years you come back and buy, let's say, a newsletter where you find other long-term cases. That's very hard to have a business model like that. Vast majority of people are short-term focused. Vast majority of people are in fact momentum traders or traders. So that's what's going to garner the most interest. Just look at crypto. Nobody really has any idea what that stuff is worth. There's no real, fundamental calculations. There's no reference points or anything like that. It's like the pure casino trading sardine kind of stuff. You'll never like. I hope you get what I mean. It's like it's pure guesswork, and that's fine for most people because they don't want to do the work anyway. If somebody throws out Bitcoin is going to $1 million because of a few reasons, that's good enough, because it could happen, and it's not going to be like I don't know. I mean, nobody's going to buy a gold deposit which has 0.1 grams per ton gold. Nobody's going to fall for that in the sense that, hey, this could be worth $1 billion. Everybody would see, no, that's not economic, that doesn't work, that's a pipe dream. But if we're talking pure trading sardines, where it's like, mostly it comes down to, sentiment, greed, and fear, and what have you, then you have no idea. There's no real rule book because there's no real anchor either. But let's get some perspective. So again, I've been asked to do some Copium videos because like the sentiment has gone sour again just over the last one and a half month. We've had a correction in juniors. We've had a correction in gold and silver. They're still very healthy prices. Again, silver is highest since 2013 basically. Gold is still $100 below all-time highs. Is there really much to complain about? No, but people are just it's kind of ridiculous that we need Copium here. It's just insane when you think about it, but that's the time perspective. People need Copium and get nervous or whatever, but simply because it's not going up in the recent past. Here people didn't need Copium. Here people needed Copium. Up here people didn't need Copium. Down here people need Copium. Most have no long-term plan. If I bought gold because, hey, I have a 5-year horizon, would I give a shit really? It's like given the state of the world, would I give a shit really if gold is at 240 or 2350? No. If my time horizon is 5 years and I can see, I don't know what could happen in that time frame, but it's like, no, my expectations would be that gold is just going to be higher. I don't really care what happens in the meantime. And until I see that, everything is fixed, let's say, I don't care because my case is intact. It's a shit show. It's going to end badly. One day. Maybe in the next 5 years. You wouldn't care. It's like I have, the physical metals I own. I don't give a crap where I just hold that for, the real end game kind of stuff or the aftermath. I don't give a shit about what happens from a day to day. It can go up or down on quarterly inflation numbers or monthly inflation numbers. That's not part of the end game whatever. It's like, oh, inflation is 3% instead of 3.2%. Gold goes down. Well, now I guess everything is fixed. No, it's complete noise. But it's the short-term stuff because every day there's something that has some kind of reaction because price moves every single day. So let's forget about the short-term belly aching a bit and let's look. This is from Excelsior. That's Shad from K Report. This article is from 19th of June. So he's looking at some indices and junior miners. So here you have the SILJ. I mean, look at this move here off the bottom. That's a good move. I guess this is the same and just overlaid by price of silver. Let's look at some juniors, not all, but like Avino. 156% gain, bottom to top. 150% gain. 145, 200%, 171, 167, 113, 98, 97, 89, 90, 85, 108, 122, yada yada yada. And now people are of course again complaining. I mean, some of these juniors are still, even with the corrections, they're still almost up 100% since late February, early March around the PDAC, which turned out to be a PDAC bottom, not a top. And again, people are already complaining because it's like, and I've seen that today when I pointed this out. It's like, well, there's not much to cheer about. One shouldn't be whatever happy or anything like that because, like, hey, most juniors are still down from the multi-year highs. And that's true. But that still doesn't take away that this has been for some juniors over the last 3 months are up around 100%. So they're like, well, there's nothing to write home about because, they're still down from multi-year highs. Sure, but some of these juniors, they're higher than they have traded for the last year, maybe 2 years. So if people actually did what everybody says they're doing, buy low, did you really increase your buying over the last 1-2 years as the juniors went down? I doubt it. Look at the record low volumes. Some days I was the only guy buying some what I think are high quality juniors. So if I'm the only guy, how can everybody be, I actually did average down? No, most people did not average down. So after a move like this, it doesn't put up that big of a dent versus someone who's like, I like silver, take Vizsla silver. As the cheaper it gets, the more I buy. And there's several months here, so it's like, if whatever you spread your salary out in some of these juniors over months, I mean, you could have upped the stake, pretty good, and then you could do some value shuffling, for example. I'm just trying to find me. I mean, take this. Well, this is February. I mean, this is early February here. Vizsla is up here. Dolly Warden is down here. I don't know what the news flow was, but it's like, yes, there's potential for value shuffling probably. Imagine it's like, okay, you like them equally much when you bought both here. February comes. Dolly Warden is up here. Vizsla silver is down here near the lows. This is at multi-month or 52 weeks highs. And let's say value didn't change much. There's some value potential here. This ran 108%. Vizsla ran 85% from the low. It certainly didn't run 85% from the low. So if you did value shuffling here, for example, a bit, you were actually in some profits, and not that you tried to predict anything. There's like, because this obviously looks like a breakout. It kind of cut through this resistance line here, whatever, and then it again went kind of vertical. Nice leg up. A trader would look at that and maybe buy. A value investor wouldn't care about how the chart looks, and especially if you also own Dolly and you thought they were kind of comparably cheap back here, all of a sudden you have Vizsla up here and Dolly Warden down here. I don't know what kind of return you would have gotten if you just averaged down here. Maybe your average is here. Let's say you're up 30%. And you buy here. You value shuffle here. So you take a 30% profit. And then you get around 100% gain. Nothing to do with trading. I mean, how many traders will be buying a candle like this? Not many, I think. Value investing, assuming nothing big really happened, that's a clear cut. If price went down and value didn't go down, obviously it's just a better buy than it was here. And vice versa, if value didn't change but Vizsla just spiked, that's less of a buy. Even it might be a buy still, but it's less of a buy than maybe Dolly Warden. So think about it. But if you're a trader, again, if you stick to both or whatever, it's like, I'm supposed to be a value investor, but now there's a breakout, so I better buy. Well, you bought the top, and if you say you're a value investor, but you're really not, so you get shaken out here. This happens all the time in this sector, which goes back to my previous point. You have to stick to your guns at all times. You have to force yourself to stick to your guns. If you are, as you say, I'm going to do the whatever value investing approach or risk reward approach. Well, do you really? That's a big thing. Do you really? Do you really have that discipline? Here it's not as simple if you look at these three. I mean, they're kind of, all of them kind of bottomed. So there's no clear-cut value shuffling opportunity here maybe. But they're low, so maybe if you get a salary, you buy a bit of all three because they're all down. And then they all went up. And now we're at this is from June 19, so they might be down a bit more. But it's like, if you're not happy with this because, I'm already down, whatever. But think about how outrageous a move like this really is. If you have juniors that are on a pace of doing 100% over 3 months, which again, I know people will bitch about, I've seen it today, because, well, they're still lower than the multi-year highs, so it doesn't matter, it's nothing to write home about or whatever. That's, in one sense, yes, I understand that, but still, this is an outrageous revaluation pace in itself. If these juniors, which people are already complaining about, after doing 100%, let's say, from the lows in 3 months, if you started with a $1,000 investment, you had a compounding rate of 100% per quarter. In 5 years, $1,000 would be worth $31 million. That's outrageous. That is obscene. And still, when the recent past has been like 100%, again, people are already complaining. It should go up more, should go up higher. At this, it hasn't paid. But how many months or how many quarters of like zigzagging upwards 100% every 3 months do you need to pay for it? I mean, if you were down 67% at the lows, and your average junior from the low, when you're down 67%, is up 100%, you only need actually if we start here and it's up, you're down 67%, so you're up at only down 33%, a double from that, you're already in the green. So theoretically, another quarter of this move that people are already complaining about because it's too slow, it's not going straight up, you would already be in the green. Think about that. Again, I'm going back to the fact that nobody has any idea. Their expectations are totally surrealistic. But it comes from an emotional space where it's like, well, I'm down this much, and it's gone up, and it's rolled over, and I'm still not in the green. So they look at their results, their portfolio results, and it makes them whine because they're still anxious. This might be the first leg of a bull market. This is an incredible growth pace, as evidenced by this fact that if you would compound 100% every 3 months, in 5 years you would be a multi-millionaire. So we have no real right to complain about the recent 3 months. And obviously, if somebody actually did average down, their portfolio would look even better than someone who bought just the highs, stopped buying the last year or two because it sucked, and now they're waiting for a breakout. Because they probably bought some of this move here, whatever. Because let's face it, let's say you only invested around the highs in the cycle. You're down, 50 to 70%, and you refuse to buy low. You want evidence that it's a turn. Okay? So you're down 70%. Don't average down, so you don't drop that average. So you need even more in terms of the, a bull market to claw back your losses. Then it goes up. Now you start buying. Because again, in your head, you're like, no, I gotta confirm because everybody else says that I need confirmation that a bull has started. So you're gonna be buying the next top. You're going to be buying here because it broke out of this whatever. You're already, congratulations. So your first buy might have been here. You didn't average down at every dip here, for example, over the last year. And all of them would be in the green here, by the way. Especially if you average down even more, the cheaper it went, your portfolio would be even better off. But you don't do that because, again, you're shell-shocked, you're anxious, you think this is going to go down forever because that's what people told me. This could go on for another 4 years. All of a sudden, boom, up. And now you buy in because now the sentiment is positive again. And now that trade, the first buy you did is already, let's say, minus 30%. So you're going to feel even shittier. And then you're going to be complaining about this was a false start. This was a dead cat bounce. Because now it's down again. And now you again hold off buying. Or maybe you sell. Because now you think there's 4 more years. That's what people do all the time. They throw that stuff at me. It's like, oh, this could be another 4 years. I don't care. Nobody knows. I have one strategy. That's my portfolio is supposed to be made up of the cheapest juniors I can find at any given point in time. Best risk reward. They might be highly risky, like 90% chance of failure, but in the case that they work out, they're going to do much more than 100%. It's not, if something is cheap, it's not guaranteed you're going to make money on it. It's just that if things turn out well, if your case plays out, or if your blue sky case plays out, you're going to earn much more than you should, because it never should have been that cheap in the first place. It was pricing in a 1% chance of success maybe, but you think, hey, it's 10% chance of success. It's significantly undervalued, even though there's a 90% chance you're going to lose money on it. So something can have low chance of success and still be incredibly cheap. Although, as I've said, for the last X amount of months, beta has gone up in value. The cheaper proven success became when you know it's like, okay, as Pierre Lassonde says, this sector always crashes and always rally. So if ounces in the ground went from being valued at $80 per ounce in the highs of, 2016, 2020, and they're down to 15, could it go lower? Absolutely. But the big move is going to be up. And you don't even have to take exploration risk because they've already proven they have ounces. Other things can go wrong, sure. Like a developer, for example, ounces in the ground, they risk, yada yada. But they put it into production, it doesn't work. Yes, that's obviously, that's the rubber meeting the road. My point is that most people who bitch and complain about this sector, they actually don't. They really have no right because they haven't followed a strategy anyway. They do exactly this kind of stuff. I'm gonna try to find. This is a good post on that subject. So I saw this post here, or I saw someone post this on Swedish FinTwit. This is H&M, large cap company, and it's like kudos to this guy. He put this up and said something like, I don't think this is the way you're supposed to do it. This basically highlights, again, most of the time, Twitter is made for bragging. Social media is made for bragging. You're 98% of all the charts, or especially a buy and sell short like this, are going to be the ones that worked out. So at face value, everybody seems to be doing it right, because the only stuff like this you see is when it played out perfectly, and it's a brag. So you think that, whoa, they did this, they did that. Everybody's such a super investor, and you're looking at your portfolios like, I'm still down. That guy must be really great because he puts up charts. There's like always almost flawless. You have no idea how those people's portfolios do. And I've said this before, if people like to brag on social media, don't you think they would have bragged about their portfolio, which is much more important than if they made some good trades in a 2% position. Of course they would. Why wouldn't they brag about their portfolio? Just some individual cases, let's say. That doesn't make sense. So they would brag about individual cases, but not brag about their portfolio. If the portfolio was as good as, you know, their individual trades, let's say, of course they would. But this guy, you know, honest guy, he you know, doesn't take himself too seriously. But you can, this is literally what happened. I mean, obviously this guy doesn't really know what he's doing. You can't probably find any kind of value investing here. But to be fair, I don't know what the news flow has been. Maybe the case was intact all the way here when he bought and something happened, price went down, and then he started selling. It's not impossible. I just highly doubt it. This perfectly lines up how people do. How people work. Maybe he got interested in the stock market 2015-16. Maybe the stock market did well back then. Okay, so you have almost an exponential rise. I mean, this move from here to here, people were making money hand over fist in H&M. He sees that, wants to, you know, make money in the stock market as well. So he starts buying again near the top, near when the sentiment is highest. So it pulls back. But he's seen the charts before here where it's like, oh, this didn't last too long. This stopped falling here and then just based and then went up. So he has some kind of maybe, you know, idea of dip buying, and everybody says that obviously. I mean, that's what people say all the time. Oh, I'm ready to buy the dip. I'm ready to buy the dip. The dip happens. They might buy the first dip. The dip gets dippier. Some might buy that. When there's a bear market, they stop. So what he did here obviously is what most people do. So we can pretend that this is the highs of 2020, 2021 in the junior sector. You see people talking about, you know, from the COVID lows, how the miners did 300-400%. And after they've done 300-400%, then the short looks really, really nice. Let's actually, well, I don't have a, I guess, 1 second, Genie XJ. Huh? Okay. J. Yeah, I mean, this was the move out of the COVID flash crash. Straight up. $239% in just a few months. And, you know, multi-year highs and all that. Yeah. Do you think people were bullish here? People saw this move and they started projecting it into the future. Same as here. Here sentiment was red hot. I remember silver miners and all of that were pricing in much higher silver prices than what silver was trading for. So one could say, you know, let's call it, or let's say similar situation as here. Things just, H&M just went straight up. And I kind of know for a fact that a lot of people, this is when they entered. So they entered around here, started buying the first dip, not too scared yet. Okay, bought a bit down here maybe. Here they might have stopped buying. Boom, up again. Now they get hopeful. Maybe they actually added here. Boom, down again. Stopped buying here, went up. Maybe try to top off, whatever. Here we have depression. When this move here came, it's like, nope, giving up, stop buying. Maybe bought some here because, you know, a higher high, went down, back to depression, refused to buy more. Down here, they think it's going to go down here, obviously. Goes up a bit, yeah, you know, some hope, whatever. It's like, yes, from a psychological perspective, you understand it, because it's not fun, especially if you don't know what you're doing. If you don't know how this sector works, it's not fun seeing this kind of movement. And most people will not They will buy down. They will average down to a point, but not at the the lows. Why? Because the volumes were kind of record low. So we know people were not averaging down. Most people were absolutely not averaging down. But just here, for example, in GDXJ, now you would be upward neutral on all buys since within this rectangle since 2021. Not long ago, you would be green in all buys within this box. Green or neutral, all buys within this box. The only buys that would not be in the green are here, and the tops in this box. From a move that was over 2 months, from a 2-month move here, all of a sudden, almost every buy in GDXJ, if you just really, did a buy and hold, not that you would be up a lot, and there's many years here, but then factor in, what if you bought more the lower it went? You bought much more here than you bought here. You bought much more here than you bought here. You bought much more here than you bought here. You would be doing yourself a favor. Let's say your average went down because you were dip buying. Think about that. How would that affect the portfolio? Instead of doing it like this. And literally selling the last shares you sell, you're completely out of the position at what could have been a absolute low. So your share count went down. Well, here it went up. Then when it got really cheap, let's say, it went down. Instead of, even if this guy just stuck to his guns, let's say, and he would be averaging up all the way down. His average might be around here. At this point, he would be red on every single buy he's ever done in H&M since 2016. But if he kept at it, he might be down minus 20% or 30 or something here. That doesn't still look good if you're down minus 20, 30% in this amount of time. Sure, I can understand that. How do you fix that? Well, you obviously increase your buying at the lows. You stop piling in at the highs every time. There's a bunch of stuff. So if he just changed that, then we go back and look at his portfolio the next 10 years. Gonna be completely different. Maybe he gave up here. His average, let's say his average is up here. Maybe gets it down here after buying all the way. So his average is up here. And he starts selling down here. He might be selling at a 50-60% loss. If he just averaged down all the way, if he increased his buying here, would look even better. But let's say he's down 30%. That might not sound like a lot. It's like, oh, you took a 60% loss instead of just being down 30%. That's a huge difference from a compounding perspective. Absolutely enormous difference over the long run. So just fixing that. It's like I like to say, I'm not a good market timer. I buy high. I bought juniors up here. I bought juniors up here. Why value investing works for me, let's say, is because I buy more down here. I refuse to sell low. That is the unforgivable sin that I cannot allow. But that doesn't mean I won't be selling some juniors basically at the low, because I might do some value shuffling. I've taken a lot of big hits percentage-wise. Some positions I sell and they're minus 60-70%. Maybe some I sell at minus 80% or whatever. The thing is obviously that the ones that work out, they can do a lot more than 100%. It's like I showed for my some of the hodl portfolios. The 3 biggest earners have more than paid for every single loser. At least in some cases. Sometimes it's like, and depending on time period. But it's like I think like the biggest earner is like 3 times the profit and the biggest loser is in losses. So I could have had 3 similar sized losses and one, my best performer would paid for 3. But I have a lot of ones there's like smaller positions, 1% position. When you think about it, okay, high risk, let's say I have a 1% position, probably not going to work out, but if it works out, it could pay for a lot. If that gets cut in half, that's minus 0.5% of my portfolio. Who cares? It can't kill the portfolio. And my larger positions tends to be the ones where I don't think I'm gonna lose. So the highest risk ones are small enough typically that they can't really kill the returns. The larger ones have a low chance of killing the returns because they're much less risky. Makes perfect sense. And this I think is, again, I put this up a couple of times. This is the chart of a Defiant Silver. So this is a bull leg. I mean, from the lows here, I think it did maybe 1,000% or something. Yeah, more than that actually. This is 10 cents. This is like what, 5 cents, 6 cents? But it's like, okay, let's not kid ourselves. We're not going to get a full position at the bottom ticks. But just from this plateau here, that's 473%. And this, I think, is over March, whatever, 9 months, let's say. I think this is the 2016 run. I think so, at least. Look at this. Look at these corrections. And you can see it's like this period could say it's consolidated. It shot up, consolidated. Shot up again, consolidated. Shot up 2 days, consolidated. Kinda all the way to here. Shot up again, started consolidating. So my point, like I say here, reminder that a bull leg in juniors probably feels more like a bear leg most of the time. If you zoom out, if you're zoomed in, you're here, you're already complaining because it's down. Down here you're complaining a lot. All of a sudden shoots up. Not much higher than the last high, topped within 1 day, started to go down again. So out of this time period, how much are you sharing really? Maybe 2 days. Maybe these 2 days people are actually content. But then the opposite happens, so it goes to disappointment because they were projecting this, of course. So I would say people are probably bitching 90%, 80-90%, even in a bull market, kind of. Because there are so many corrections and consolidations, and you really have to zoom out. Because if you just look at all the losses, like you would think, and it looks like it's going nowhere fast, really. Yeah, you can see it's kind of a trend. And then you think about it, it's like, this was a 473% move. You would be happy if you get a move like that and it took 5 years. This happened over 8-9 months, and I promise you, people were probably still bitching most of the time. And this, of course, shows that there's so much chaos in the short term. And if you can't stomach 30% declines in your holdings or your portfolio, you have absolutely no chance in this sector. Absolutely. Don't even think about it. Especially if you're a value investor. No chance. And of course, when you think about, okay, here it dropped 31. Let's say the case was intact. This move was going to happen. If it dropped to 40, 50, people would be bitching more. But if you were actually a value investor, you would get much higher future returns if it went down 40, 50% more here. Or, more than 30% and then rebounded and went higher. You would have made more money. It would suck even more in the short term. If you again actually did buy dips. But this also comes back to the fact there's like I see people sharing all the times like, oh, you know, they own a stock and it's up 10-15% and they're, you know, going crazy. It's like, woohoo! Well, if you share of 10 to 15% daily swing to the upside, you have to mourn a 10-15% swing to the downside. And that kind of tells me that, again, people don't really know what they're doing. They don't really have a case. Because if you're after 30% returns, why even be in this sector? It can drop 30% in the blink of an eye. That's just a rounding error. That's like week-to-week volatility is a 30% move. And how is 30% gonna pay for anything if the typical junior again can drop 30% in a week, in a day even sometimes? I mean, typically that's when it's bad news, but in a week at least 2 weeks, yeah. And if you go into a bear market, which we, you know, last 4 years kinda, I think we might be out of the bear market, but still, 30% is nothing. The median junior went down 80%. So why are you sharing 10-15% moves, let's say, like it really matters? I'm after these kind of returns for, you know, individual stocks. Then they can pay for something. Why, you know, if my case is, let's say, define silverback here, it's like, oh, I think the value is up here, and it does this. Should I go crazy? But my case was that it, you know, this is the price to value gap that could be closed, and I buy here, and this happens. Why? It's like you're shearing if you're running a marathon and if you've done 1/20th of the marathon and you're acting like it's a big deal. A lot of people can do that. A lot of stocks can go up like that, and they can still go down. I mean, we're in the summer doldrums right now. I personally like it in a sense because I don't really watch the medals anymore. So I've gotten bored by the markets because they are kind of boring. And I've heard the expression never sell a boring market. I think this is great. We're going into, and I spoke about this on K Report, we're going into assay season soon. I mean, juniors have started to drill or start to do field work at least up in the north, for example. So it's typically the news heavy side of the year is the second half. The first half is not as news heavy because there's been weeks now where it's like, oh, you don't see much in terms of interesting news releases. So everybody's bored. Everybody's already in a depression, despondent. And you see that news, even though it's not maybe material news, but it kind of suggests something about the next 10 news releases, people don't care. So I think we're kind of getting quite primed, honestly, especially if gold and silver stays at these prices. I mean, the risks are to the upside just based on valuations, but it's like we're going into also the potential quantum leap period of the exploration cycle, where companies can prove they have discoveries, prove up more of their discoveries, all of that. That's a good thing. Oh yeah, I mean, this is just an example. For example, just an example. For example, I did an article and a video on First Nordic. It's like, this is the kind of stuff I like. Again, we're not going into rounding errors here. So it's like, if my idea is like, I think this is, you know, a fair conservative base case value estimate for First Nordic. If I really believe that that's my conviction, I have this gap that I think could close one day. At least, and this is just for Barcela alone. Based on the current version of Barcela. That's quite some gap. Then we're talking returns. So if you're, again, I'm not saying it's like I might be wrong. First of all, I think I'm wrong to the downside. I think this is quite conservative. And we know now that nobody really gets the fair value anyway. So that's fine. I mean, that's the sentiment aspect of it. Sometimes they will actually trade, a junior will trade over NAV, and at lows it will trade significantly under NAV. So just from, I mean, this is, I mean, here, for example, nothing changed with the project. Let's just look at the highs of 2021. I mean, not much has changed for Barcelona. It still went down almost 90%. That's basically mostly due to sentiment. The project didn't lose 90% of the ounces. It didn't lose 90% of the economics. Gold went up. So there's obviously in the junior space, sentiment is a huge factor. But that's also what we got in store. We have the highs, we have the exponential runs that comes from sentiment, and we have the severe crashes that also comes from sentiment. Without much happening to a stock, the stock can go up hundreds of percent and down 80%. We've seen trading sardines do this, for example. But if my idea, again, if I'm going to be in a high risk, high reward sector, the wins need to be big to pay for a bunch of losers. The few that make it, I better, get a lot out of them, let's say. So if in my mind, I have full conviction that this is, again, right or wrong, this is the gap, I think, at least is going to get closed. This is my back pocket returns. Sooner or later, one day in the future, my base case is I'm at least going to get a 343% return in First Nordic from these levels. Obviously, that's a return you would be happy to get even if it took 5 years. Not many people are. They expect this, again, judging by the fact that people are bitching about 100% over 3 months. This is what people expect to happen in three months, or else it's like something has gone terribly wrong. This goes back to my aim big and conviction, and it's like I think yesterday up 12%, and that's a good one-day move. It's in a sense an outrageous one-day move. In a sense, if this is the fair value, it should revalue to this portion, to this level today, without any news. Because if one's like, the market is supposed to be rational. In that case, let's assume for a second that this is actually the fair value. Then it should be up here without needing a catalyst. It's not, obviously. And it also goes back to the fact that the alternative cost. It makes no real sense if Barcelona was the only one that was rationally priced and everything else in the sector was trading at 60% discount to the intrinsic value. Obviously, that's typically not going to happen. Because in that case, I mean, if Barcelona was trading up here today, if it was at $1.6, even though I might think that, hey, okay, this is a fair price for the base case, but it's not pricing in exploration, so it might still be cheap, but the opportunity cost is obviously the other ones that are still down here. So in that case, it might be cheap, and in a sense, still a buy, but I want the cheapest juniors out there. In that case, I wouldn't be that bullish on Barcelona relative to the other, or First Nordic, relative to the other place. But if you have this conviction, how are you going to get long big returns? This took 9 months at least to play out, and huge volatility in between, a lot of times to get shaken out. The only time, or the only people that actually were along for the big move were the ones that could stick through it. If somebody had the convictions, like, yes, I think that 90 cents is fair value for the fine silver, they would stick it out. If you have no idea what you think the value is, you probably would have made a lot of mistakes and would not be even close to this. So I know most people are traders. People probably might have bought here, they sold here, they were happy. It's like I get a 20% return on a 1% trading position. Ooh, I'm the best. I don't give a shit about those returns. Those are rounding errors. That's why you don't see me cheering. It's like, oh, a junior I have is up 10-15% in a day. Well, if my case is that it has maybe 343% left to go, then 10% is like, again, a rounding error. Why would I be cheering about that? Like I won something. No, if the play to me is that this is probably going to be a multi-bagger, and in that case it works out, because then I take advantage of the reward side of the high risk, high reward potential. But if I'm just, my case is that I'm going to be up 10% in tomorrow or next week. What's that going to pay for? When I, can have stuff that's down 60-70%. That's not going to pay for anything really. And is there an edge in that? Me guessing what the price is going to be next week? No, I don't see that. So if I want these kind of returns are not going to happen over a week or a month. Typically, there are exceptions. Maybe my case is, if I do nothing, I think it's going to climb to this, maybe more. Let's say it's going to go like this. If just that plays out for this case, and I have a, decent position all the way through, it's going to pay for a shit ton it's going to pay for maybe 10-15 juniors that went down 50%. The same with home run, for example. I mean, these are two of my largest holdings right now, for example. Do I know home run is going to work out? No. But my case is like, hey, this could be a multi-bagger and more from here. But it's like, is it a good case where it's like, I buy in here, I think I have no idea of the upside potential, and it's like as soon as it's up 20%, it's like I'm gonna take my money and run. Maybe, just maybe, this is the case. That's like, even if you say the case is, well, it's either gonna go to zero or maybe somewhere along these lines, like a span here of, I don't need to be exactly right, but maybe this is, maybe I think there's a 50% chance it's going to trade somewhere in this value range, that the value within 18 months is going to be somewhere along that's a pretty good case. If I think there's 50% chance of that happening, so 50% chance that everything turns to shit, and 50% chance I get a good multi-bagger, that's obviously a absurdly good bet. Because if this works, it's going to pay for a shit ton of others. If I could find a bunch of stuff that I think had this risk reward, man, my portfolio would do well. 50% of the time it's going to pay for itself and a bunch of other stores that went down 100%. Twice as much for the ones that went down only 50%. And I get 50% wins, 50% hit rate. If this would be if we play around with the idea that yes, this is legitimately, if anybody could know, this is actually the true risk reward. There's exactly 50% chance it goes down 100%. Exactly 50% chance the value is somewhere around 5.5 to 9.4, whatever. Absurdly good bet, obviously, because every other that's a winner is going to pay for much more than any other that's a loser. So that's absurdly good, even if it's just 50% hit rate, which is, I mean, for a junior that's high, except if we're in the bull phase when everything goes up. I mean, here everything went up. Here almost everything went down. But I'm just speaking from a price to value. If I think the value could be up here. Inflection resources as well. I mean, what's my case here really? It's like, oh, if I buy inflection, I have no idea what anything could be worth. I don't really have a case. It's like, oh, I think it could go up a bit. They put out some news items like, oh, they might have a discovery. It goes up. What's that like? Let's say it goes up 50%, and it's like, okay, I'm taking my money and running here on a discovery hole. Is that really what inflection, for example, is about? From a fire and forget perspective, I would say, no, it makes total sense to me if, okay, they're going to be drilling a bunch of areas over the next, let's say, 12 months. And we know it's trading at 17 million CAD. I would say the most straightforward, probably no-brainer approach to a store like this, for example, management got a lot of skin in the games, a bunch of targets, got to be a bunch of news flow over the next 12 months. What's wrong with like, hey, I think a lot could happen within 12 months, so if I pay 17 million, I'm probably going to be down on it. They have other projects as well, so I don't even see a 100% decline. They're fully funded by their partner, for example, with the copper projects. So, let's say I have a case where it's like, let's say they miss everything, story gets really boring, I lose 50% on paper before they do something else with the company, let's say. Then I also have the other side of that coin is that they're drilling multiple targets and they're looking for world-class deposits. So if something goes right, it could go extremely right relative to a 17 million market cap company. So is trading inflection the way to go? It's a pretty low liquidity stock. It doesn't make sense that, oh, I'm buying here because I think I'm looking for a 20% return. Well, it can go down 20% in a week, easily. Maybe in a day, with no news. Just somebody needs to sell some shares. Is that even a case? Or is that just gambling/guessing? And completely ignoring, it's like, okay, given what's going on, given the fundamentals, what's the best way to play this? Where is the actual risk-reward good? Is there a case to say, on a 1 week basis, inflection is superb? Meaning that, oh, given the fundamentals, it for sure is going to be up a week from now. No, nobody can say that. Might as well be down in a week from now. Makes absolutely no sense. There's no brainer in that. That's pure guesswork. But just having such a simple case where it's like, okay, I'll buy this, I'll hold it for a year or two and see what happens. Given, again, the fundamentals of the company. A lot of targets, they're looking for big targets. If they would find a, whatever, world-class deposit. I mean, 17 million would not even be in the same dimension in that case. Again, let's say they do make a discovery. Let's say they have a discovery hole. It goes up 50% or 30% within the first minute. And that's not saying a lot, but let's say it does that. And you're like, okay, yeah, now I'm selling. Where it's like, what the hell? That was a discovery hole. If you were playing for 30% gains, you might as well not play at all. I think some of these cases are much more like, okay, I mean, it's not going to be easy to sit through, but it's like, hey, if this works out, it might go like that. In that case, yeah, it pays, then the risk reward makes sense. Huge targets, bunch of targets. If my case was that I'm gonna drop out with everything I have if I see a 30% rise, that makes absolutely no sense to me. How that's not going to pay for any of these other stores that don't pan out. So if you had 10 inflection resources, let's say 3 out of 10 actually worked out, even despite the amount of targets that there's so many. Let's say 3 out of 10 worked out, and the 3 that worked ended up becoming 10 to 30 baggers. And so let's say there's a 70% chance of failure. I'm not finding anything, they go down 50%. Or let's say 100% to be a bit more conservative. How on earth are the 3 winners going to pay for 7 losers that went down 100% if you sell the winners after a 30% gain? Because you have no idea really what the risk reward was all about, how the risk reward made sense. It makes no sense to take high risk for low reward. And the only way to get a high reward is for, to let time play. Look at the Lundins, look at their success stories. They didn't become 10, 20, 30 baggers from one hole or 1 week of holding it. That was over weeks. Or let's look at file action. I mean, even after this, let's say, this discovery hole here, it's like you would be up 80%. If you bought here, you would be up 80%. That would pay for, a few losers, I guess. This is what you left out. And if you look from bottom here, this is what you left out, 552. Now we're starting to pay for stuff. Obviously, the lower you bought something, because let's say, or put it like this, geology didn't change. Well, hasn't changed for millions of years. I don't know what the news flow was, whatever, but it's like, this is the same project. The geology didn't go anywhere. This is when it was revealed what is actually there. But if the case is intact, we're in a lull, for example. This wasn't really a lull, actually. But there's a lot of stuff. I mean, I would say inflection, for example. This looks like a lull. Does it reflect the news flow? I don't think so. The geology there in the ground hasn't changed for millions and millions of years. But the stock has its own life. My point is that a lot of the time, fire and forget is actually what makes most sense. Especially with high risk, high reward stories. Because if you cut down the potential, now there might also be a case where it pops, then it doesn't amount to anything. So in hindsight, you would be like, oh, I should have sold. I'm going to remember next time I'm going to sell every discovery after the discovery hole. Let's say that's what you learned. Well, you're going to cut down every tree in that case. Then we're back to the fact that this is high risk. And if you take high risks, you need to have some high reward to offset the high risk. But if you go in selling you bet on pre-discovery maiden drill campaigns, your entire portfolio is made up of early stage explorers. And you've learned from one time where it's like it went down here, and you learned that I should sell after every discovery hole. That is not going to end well. Because let's say 8 out of 10 don't make significant discoveries. The 2 that does, again, you sell them at 50 to 100% profit. And the 8 other ones go down 50 to 100%. That's a money losing. That's a way to grind down your money. So you kind of, in that sense, you kind of have to take a leap of faith. Because let's say, this might be a better example. Let's say you have 3 out of 10 make a discovery hole of some form. The option is, again, that you sell them at the first discovery hole, so you get, let's say you get 50 to 100%. Yes, there are some that runs a lot more than that and might actually be, overvalued, that it makes sense to cut them down. But let's say they just open up 50 to 100%. You sell all those 3, the 7 other fail, and you lose money. Let's say one of those 3 that you sold on the discovery hole, let's say one actually turns into a significant discovery. That alone might pay for the other 9. especially since you, made money on the two others, but you sold them at 50 to 100% pop. So your portfolio would work out if you let that run, and let's say it became a 10 to 20 bagger over the next 3 years. You would have a green portfolio. And in that scenario, we would have 2 out of 3 discovery holes that ended up missing. So they went down. First one popped. In this case, you didn't sell. So first one popped, went down, couldn't follow up on it, wasn't a real discovery. Second one popped, went down, and again, you're getting twice the lessons, like I should sell the pop, you should sell the pop, but you don't, because you stick to the strategy that, one of these needs to pay for the other ones. I can't just take high risk and low reward. The third one, legit discovery, goes up like that, and you make, let's say, 550% returns. And the other 2 or 3 or whatever, they're down maybe 50% whatever. It's like, and this is from 549%. That's much better than the opposite. If you sold all 3 after a pop, you would lose money. If the other ones got cut in half, you would, pretty much be in the green. Just from one play that went up. If you had a 10% position, it went up 550%. And that's without 10% hit rate, 1 in 10. And that's called only a 550% return. But if you don't give any one of the high risk, high reward plays chance to prove up the high reward, then you should not really be in high risk, high reward plays, because then you're not, at face value, you think you're in a high risk, high reward. But in practice, if you can't play the numbers and follow through on that strategy, you're actually playing a high risk, low reward game. Then it makes no sense. And also goes back to the fact that people are bitching about this move right here. About this is nothing. Well, give it time. Give it time. If you're going to have big gains, you have to have long holding periods. But if all you see is the short term, and you get shaken out, I refuse to buy. Oh, it's up now, so now I'm gonna buy because there's momentum. Good luck. You're gonna get killed in this sector. Absolutely killed. Just again, think about it. If I literally take Inflection, for example, I literally bought Inflection, threw away the key. No trading. I invest like the dead. Okay, no trading whatsoever. You have an idea, it's like, okay, either they're going to find something or they're not going to find something. If I threw away the key, came back 5 years later, if they found something, maybe that stock got bought out. Maybe Inflection got acquired for 600 million. My portfolio would have a big fat gain. Or they didn't, and I lost on it. But if especially with good management team, you give the success stories, you give them time to play out. Obviously, a company can drill up more ounces if they get 5 years instead of 1 year. Or especially if you just give it a month, they can't really prove up anything. So expand the time horizon and that's the HODL portfolio approach pretty much. They're supposed to be fire and forget plays. Yes, they will naturally concentrate themselves in time, but it's like, how do you beat? This is the most common sense, low maintenance stuff you can do. And for cases like, for example, Inflection or whatever, home run or the more time I give them, because they can only go down to 100% anyway. They can only go down 100%. If I give them 5 years, they cannot go down more than 100% anyway. But if the reward side plays out, I'm probably going to be up more in 5 years than 4 years, and more in 4 years than 3 years. So it's the time that dictates the reward side really the most. If it's a growth play, if they make a discovery, it's the time. Great Bear was sold at its peak valuation. Great Bear was worth more 3 years after the discovery than 2 years after the discovery. And more 2 years after the discovery than 1 year discovery. From where you bought in, the downside was always fixed at 100% anyway. So I mean, think about it like this. Okay, you have a growth case. If things go well, it's going to grow like this. This is year 1, this is year 2, this is year 3, this is year 4. So it expands with time because they prove up more and more the more they drill, because it keeps growing. That's not to say that every single one is going to grow. Some, again, they make a discovery hole, doesn't pan out. That does not change the fact that the ones that pan out probably will correlate. The more time you give it, the more money you're going to make. Whereas the other side is zero. They don't find anything. This is year 5. Whatever. They get killed on day 1 or something. I know. They go bankrupt here. It doesn't matter. From your purchase price, the reward side should be expanding with time period held. If they keep growing, obviously. And the downside is fixed anyway. If I give a growth case a month, or let's say 2 months. Yeah, I might have added this in value. Or let's say, you buy it here. They actually... okay, the value change in 2 months, the management has been able to generate 20% of value. Okay, sure. If I gave this management team 5 years, they might have produced 1,000% in value. 1,000% more than what I paid for it. All of a sudden, it's going to pay for a lot of other ones. I hope this makes sense. It's like we're in the summer period. I love it in the sense that, hey, everything I own I think is cheap. I wouldn't be surprised if any of my holdings showed a lot of green one day if I didn't sell any of them. Just from a sentiment perspective. It's like, okay, if assuming few, if any, went bankrupt, I'm going to be, just from sentiment alone, I think I'm going to be up a lot one day. And that's including dilution. Because I think that the sentiment is that bad and they're this cheap. To me, I don't have anxiety. I feel like I'm playing a rigged game. To me, it's a matter of when I'm going to make money, not if. Especially given where we are, that we're so low in the cycle. Up at the cycle highs, it's more about when, not if, I'm going to lose money on paper. So I don't have anxiety. I actually enjoy it because I know it's like whatever gold and silver does, it's not going to change the fact that I think the base case, for example, for First Nordic is around here. So this is, in my opinion, my conviction stems from I think it could easily fetch a value like this one day. So what am I afraid of? The gold price goes down and the stock goes down 20%, whatever. That was not the case to begin with anyway. And especially if I count blue sky, it's like, a blue sky scenario, 1 to 3 billion. And it's at 67 million or whatever. And I think it should be worth 350 million right now already. Not in this sentiment environment perhaps, but it's like one day. Yeah, that's a lot of room to run with. And that's not going to happen over a day. So again, I'm either going to be wrong or right. If I'm right, or if I look right, I'm going to be up a lot. Maybe over the next 1-2 years. So what's there to do in the meantime? Well, try to find an even cheaper case, obviously. But the only play for a value investor, really, all the reward comes from waiting. All the reward comes from waiting. Compare that to an active trader, a day trader, swing trader, what have you. It's like they have to be at the computer, otherwise they're not making any money. Like, I think the hodl portfolios, if I literally did nothing with the portfolios, a year from now I think they're going to be up. 2 years from now they're going to be up more. 3 years from now I expect them to be up even more. Without doing a single trade. Let's say I went on a 3-year vacation. How do you beat that from like quality of life standpoint? Anxiety, whatever. If you have that's where conviction comes in. If you're convinced that you think a case could be worth this and you're paying that, are you going to be right every time? No. Do you need to? Absolutely not. If the upside is big enough, the higher the upside is, the less accuracy you need. Like always, just because something goes up and down doesn't necessarily mean it was a good or bad buy. Things change. Stuff happens that you can't foresee. You couldn't foresee. I couldn't foresee red pine. The debacle there, I couldn't foresee. I didn't own Victoria Gold, but I couldn't foresee that a tailings, a heap leach pad failure. No way. It's like people are, I think, too focused maybe sometimes on the upside potential or the downside potential. In Victoria Gold, for example, was that probably going to be did that have 5 to 20 bagger potential? No, I don't think so. At least with exploration stocks, you know what the risks are, and you know what you have an idea maybe what the upside potential is. Inflection, for example, I can understand that's drill risk, pure drill risk. There's no tailing, there's no leach pads that can bust. And if they don't bust, it's not like I get 200% returns automatically. No, this is like, okay, there's a chance they actually do make a discovery. If they do, it's going to pay for a shit ton of other juniors if I don't sell it on the first 50% pop. Pretty simple stuff. So it's like, I don't know, I can't explain all the movements in inflection. I think it's been cheap we've been in a bear market, so there's no surprise maybe. No, I think the case has been pretty much the same. Give it 12 months. Either they're going to probably find something or not find something. If they don't find anything, okay. One I will, maybe lose 50% on. If they do find something, I can afford to lose on maybe 10 other similar stories. 15. Who knows? Pretty simple stuff. So that's why it's like I'm not as active nowadays, because I don't care. I know what I hold is cheap. There's not much to do unless there's volatility. If we get flash crashes, yes, then I will be more active. If we get stuff like, like this for example, it's like one stock I really like just goes down on no news and another one goes up on no news. Then there's something to do. In the meantime, if we're just like this, I'm just going to continue to invest. Hold the cheapest ones I have. It's like, what's my problem? What's the likelihood of some of these juniors no news and all of a sudden they're going to be overvalued? No, not much, because they're not going to revalue in a day anyway. Long rant. I hope you got something out of it. Consider me biased. If I talked about any juniors, some might be banner sponsors as well, so consider me twice biased. I would say stick to your guns. Chill and relax. If you hold something cheap, if you're sure it's cheap, you have no real problem. It's just that we're waiting for the Mr. Market to see what we see, and we can't control when that happens. And sentiment, something we can't control either, is the major dictator in the short term. That's going to always be so. Not investing advice. Don't risk money don't invest money you cannot afford to lose, etc., etc. Do your own due diligence. Bye bye.